Hey guys, Toby Mathis here, and today I got Kurt Bergfjord. Did I say that right?
You did, Toby. Absolutely.
All right, with us, the CPA, who's going to be hitting the topic. And here's our topic for today, and I like this one: how to pay zero taxes when investing in Airbnbs. And so we're not going to dilly dally. We're just going to dive right in as to if that's going to be that's a pretty big ask. Like, how are we never going to pay tax on this stuff? And Kurt's going to help us understand it and break it down. So let's dive in. Number one, Kurt, why is Airbnb different than just like regular rental properties?
Yeah, so thanks, Toby. Short-term rentals, Airbnbs, are different because they, by nature of the length of the term, are average stays of less than 7 days. So they're not really treated like a rental per the IRS. They're actually treated more like a hotel. And because they're treated more like a hotel, which is more like a business, different tax rules and different deductions that will benefit you mainly apply.
All right, let's hit on that real quick. So you mentioned 7 days or less. So if if there's a distinction, it's like if I'm just a real estate person, right? Like I just own single family homes and I rent them out on a month to month basis, maybe annually to people. Is there a special type of tax treatment that I'm receiving from that?
Yeah, so with a regular long-term rental, everything, all that income that you receive is going to be passive. And the thing about passive income, and more importantly, passive losses, are usually if you have a high enough income, you won't really be able to offset very much of your other types of income with those passive losses. And that's where short-term rentals or Airbnbs are a little bit different.
Okay, so it's treated as what, a regular trade, just a regular business?
Yeah, I mean, just like any other trade or business that you could get into,
Pizza shop. So I'm doing a pizza shop. Is
a pizza
Airbnb
shop.
basically the same thing?
Exactly, yeah. And when you have other sources of income, maybe you have a W-2, and you run a short-term rental, you materially participate in that short-term rental, you can actually create ordinary tax write-offs that can offset a lot of the taxes on your other sources of income.
All right, you just said something really, really profound there, and I want to pound this point in. So here's what happens: if you're a regular person, you're making a couple $100,000 a year, you and your family, and you have rental properties, and you get to do this thing called depreciation, where you write off the value of whatever the box is that you put on the houses, whether it's a duplex, fourplex, regular, just single family. You get to write off the structure, and it oftentimes creates losses, paper losses, especially if you know what cost seg is and bonus depreciation. You can create these big losses, but you can't use it against your W 2 income because this passive loss rule. And so, what Kurt just eloquently put out is this isn't rental property when you're doing an Airbnb. This is just a plain old business, which means the losses now become ordinary, which means I can use it to offset my W 2 income if I materially participate. So let's break that down, Kurt, so that people really get their heads around this. What are we talking about here when you talk about material participation?
Yeah, so actually there's several ways to materially participate, but when we look at the short-term rental Airbnb strategy, what we're really looking at is one of two tests. Either you participate in the short-term rental at least 100 hours and more than anyone else, or two, you participate at least 500 hours. The IRS will tell you there's about 7 tests, but we found that those 2 tests are most likely applicable to most of our clients.
All right, so let's make this real. Let's say that I'm a taxpayer, I'm a dentist. I'm making $300,000 a year, and I'm like, gosh, I'm getting killed in taxes. This sucks. And you hear about this Airbnb strategy where you can not pay tax on Airbnb, and it says, you know what, if I'm going to be investing, I would really like to do that because I don't want to pay tax on my investments. But what you're saying is, if we use this Airbnb correctly, there's a possibility that we can create loss that'll allow me to offset my 300,000. Am I understanding that correctly?
Yeah, exactly. We're going to structure that Airbnb appropriately so the tax benefits, tax income or loss from that business flow back to my personal tax return. I'm a dentist. I got a W-2 300,000. I also go out and invest in an Airbnb, run it in any given year, materially participate on that, maybe do a cost segregation study so I can front load a lot of that depreciation into that first year. Maybe I create a, $150,000 loss. That $150,000 loss now goes into the pot on my 1040 with with my $300,000 wages, and now my taxable income is only 150,000, and I only pay taxes on that 150,000. So it can be tremendously beneficial.
All right. So let's say that I bought a $500,000 duplex, and I'm going to Airbnb both sides of it, and we'll use the $300,000 person. It could be fill in the blank. It could be any income level. But let's just say that the investment itself, the Airbnbs each make 25,000 per side. You make $50,000 of income after the insurance, after the property, like any costs that you have on property taxes, repairs, all that stuff. And then now we're getting into the depreciation. You mentioned bonusing that depreciation. There's a way to do this that's going to allow you to write off, let's say, a quarter of the value of that property that you bought. It's probably closer to 30% of the basis, the depreciable basis, but we won't get into all that today. Let's just say it's $150,000. So that $150,000 will wipe out the $50,000, the $25,000 per side that we made. It'll wipe that out. Now there's $100,000 of loss. And if we do this right, you're saying that $100,000 will offset my $300,000 of income. Am I understanding correctly so far?
Yeah, absolutely. You're still going to have your $300,000 W-2, but in addition, when that goes to your 1040, you're also going to have that additional $100,000 ordinary tax write-off. So now your taxable income on your personal return is only $200,000.
And the key to this is that you materially participate. And is it just one spouse, or can you add spouses together if it's a husband and wife, or if they're spouses, or is this something where each person has to do 100 hours? What's the test?
Yeah, so that's a really good point. 'Cause for material participation, unlike some other tests involving hours, material participation is actually between two spouses. So, if both spouses are participating, both their hours will count.
Yeah, so I'm gonna drill this point home. Is let's say that it's husband and wife, and they're the only one managing the property. They go over and clean it and everything else. We don't have to worry about 100 hours. If husband and wife have somebody go over and clean the property and somebody else is participating, now husband and wife have to equal 100 hours plus, and it has to be more hours than anybody else that's working on that property. Not companies, but individuals working on that property. So if you have a company that provides cleaners, as long as no individual cleaner did more hours, you'd be good. Now we get this big write-off, and that's a huge amount of tax relief, especially for people that are really high income. You're making $500,000-$600,000 a year. There's not a lot that you get to use as deductions. You phase out of stuff. You're just not. You've been kicked out of the party. This is one of those things that you still get access to. So, Kurt, I want to ask you a couple questions about this and give you a couple scenarios, because we're talking about never paying taxes on this. So, if you become an Airbnb, could you do it for 1 year, 2 years, and then convert it back to just a traditional rental, long-term rental property? Or is this something that you make an election and you're stuck?
Yeah, no election. You absolutely can, in any given tax year, you can change the nature of that Airbnb. 1 year it's an Airbnb, the next year it's an Airbnb. Maybe in year three, you just convert it to a long-term rental. It just becomes part of your regular long-term rental property portfolio. That's certainly a great strategy.
And could I 1031 exchange that property then?
Yeah, absolutely. I mean, it is an Airbnb that you use for a trade or business, but it's still real property, and real property would qualify for 1031.
So whether it's Airbnb or long-term rental, I still get my 1031, so I can avoid tax for
Yeah,
infinity on this thing, right? I just have to die someday and my basis steps up, right?
and particularly since that first year, maybe that first or second year, you took a big write-off, you're going to have a low adjusted basis after you take that depreciation. So it actually makes a really good candidate to 1031.
Yep. Now, what about in the interim? So let's say that I do this, and Now the next year, the depreciation on that property is 20 or 30 grand, and I make 50. And all of a sudden now I have some income. How do I offset that additional income from my Airbnb?
Yeah, so in that case, you might start using an example where instead of holding that in an LLC that's merely disregarded to you, you
Mm-hmm.
might set up a long-term master lease to a C corp that you set up. You turn the master lease between that corporation and your LLC that's disregarded to you. You have passive income coming to you, and then the corporation is actually the one out there doing the Airbnb activity. With the C Corp, you're going to have a lot more tax advantage deductions, things like that, things you can take advantage of, accountable plan, health reimbursement arrangement plan, maybe even pay yourself a salary, set up a solo 401k, things along those lines, and really
Mm-hmm.
eliminate the rest of that profit there.
Yep, that's absolutely an option. Another option might be just to buy more Airbnbs and write them off, right? And hey, my family strategy is to buy one a year and take that big old write off and use it to offset my taxes every year, so that you never have to really worry about the tax ever. As long as you're buying a property every year and you're depreciating that new property, it's going to prevent your old properties from kicking you too much profit. It's the old adage that if you're paying tax in real estate, it's because you don't own enough real estate.
Yeah, and the same concept applies to Airbnbs. Absolutely, buy another one every year. Absolutely.
Yep. And so let's say that I'm a doctor. They're sitting there listening to this, and they go, "Wait a second. What if I buy an Airbnb in October? Surely that's not a trader business. There's no way owning it just for 3 or 4 months or 2 months or whatever would qualify and allow me to take that big write off. It must be stretched out over the year. Is that correct thinking? Or is it really I could buy it at the end of the year, accelerate my depreciation, and take a big fat write off, even if I've only had it in service for part of the year?
Yeah, no, absolutely. As long as it's in service by the end of the year, you are running a trader business for that particular tax year. You want to make sure that that average stay is still less than 7 days, even if it's only over that 3 month duration. But if you can meet material participation over 3 months, which shouldn't be too big of a problem between you and your spouse, you could absolutely take a large write off.
Well, this has been absolutely fantastic. Kurt, you're awesome. CPA at Anderson. By the way, if you want to learn more about tax and asset protection, come to our tax and asset protection workshop. They're absolutely free, and you'll learn all about land trusts, LLCs, corporations, how real estate and tax, including some legacy planning. Kurt, any final words, or are we good?
Yeah, just another great strategy from Anderson. Thanks, Toby.
You got it.